March 2026. In just a few hours, billions of dollars vanished from the stock market. Oil prices crossed $100, and suddenly the entire world started paying attention. But here's the thing. Most people still think this is just another market dip. They think it's temporary. They think things will go back to normal. But what if they're wrong? What if this is not just about stocks, not just about inflation, not even just about oil? What if this is the beginning of something much bigger? Because behind all these headlines, there's a story unfolding, a story of power, a story of conflict, and a story that could reshape the global economy. And it all starts in one of the most important regions in the world, the Middle East. Now imagine this. Almost 1/3 of the world's oil supply passes through a narrow strip of water, a place so critical that if something goes wrong there, the entire global economy feels the impact. That place is the Strait of Hormuz, and right now it's under threat. Tensions have been rising for weeks. Attacks on oil tankers, military warnings, and increasing pressure between Iran and global powers. But then everything escalated. Strikes targeting energy infrastructure, fear spreading across global markets, and suddenly oil prices didn't just rise, they surged. And when oil surges like this, it doesn't stay contained. It spreads into transportation costs, into food prices, into electricity, into every single part of daily life. And that's when the real problem begins, because higher oil prices mean higher inflation, and inflation is something the United States has been fighting for years now. Just when people thought inflation was under control, just when markets were expecting relief, this happens and suddenly everything changes, because now the Federal Reserve is trapped. If they cut interest rates, inflation could come back stronger. But if they keep rates high, the economy slows down, businesses suffer. Borrowing becomes expensive, and growth starts to decline. So what do investors do in this situation? They panic, they sell, they pull money out of stocks, and they move into safer assets. And that's exactly what we're seeing right now, markets falling, uncertainty rising, fear spreading. But here's the part most people don't see. This is not just a reaction, it's a chain reaction, a dangerous cycle where one problem feeds into another. War fears increase oil prices, higher oil prices increase inflation, higher inflation forces higher interest rates slow down the economy, and a slowing economy pushes markets even lower. And once this cycle starts, it's very hard to stop. We've seen something like this before, not exactly the same but similar patterns. In 2008 it was the housing market, in 2020 it was the pandemic, and now in 2026 it could be something even more complex. Because this time it's not just financial systems collapsing, it's geopolitics, it's global power, it's energy all colliding at once, and when multiple systems collide the impact is unpredictable. Now think about this. What happens if this conflict escalates further? What happens if supply chains get disrupted? What happens if oil doesn't just stay at 100 but goes even higher, 120, 150, maybe even more? At that point, we're not just talking about market volatility anymore. We're talking about a full economic shock, prices rising everywhere, consumers cutting spending, businesses struggling to survive, and markets entering a deeper decline. But at the same time, there's another side to this story, because while most people panic, some investors see opportunity. They move into energy stocks, they buy oil companies, they shift towards gold, they hold cash waiting for the right moment. Because in every crisis there are winners and losers, and the difference between them is not luck, it's understanding. Now here's the big question. Is this just a temporary correction or the beginning of a major crash? The answer depends on three things. First, the Iran conflict. Does it escalate or calm down? Second, oil prices. Do they stabilize or keep rising? And third, the Federal Reserve. Do they pivot or stay strict? Because if oil remains high and inflation rises again, the Fed will have no choice but to keep interest rates elevated, and that could put even more pressure on markets. And this is where things get serious, because the global economy right now is already fragile. Debt levels are high, growth is slowing, and confidence is shaky. So any additional shock could push it over the edge, and that's why this moment matters. Because what we are seeing right now might not just be another headline, it could be the beginning of a much larger shift, a shift that changes how economies function, how markets behave, and how people experience everyday life. So the next time you see a headline about oil prices rising or markets falling, remember this: it's not just numbers on a screen, it's a signal that something bigger is happening behind the scenes, something that could impact millions of lives around the world. And the truth is, we are still at the beginning of this story. We don't know how it ends, we don't know how far it goes, but one thing is certain: the coming weeks and months will define the future of the global economy. And now we go deeper, because even after understanding all of this, there is still a deeper layer that most people completely ignore, and that is the hidden structure of how global financial systems actually operate. Because what we see on the surface, stock prices going up and down, oil prices rising or falling, inflation numbers changing, these are just symptoms. But the real story lies underneath, in the structure of how money flows, how liquidity moves, and how power is distributed across the system. And right now that structure is under stress. So the next time you see a headline about oil prices rising or markets falling, remember this: it's not just numbers on a screen, it's a signal that something bigger is happening behind the scenes, something that could impact millions of lives around the world. And the truth is, we are still at the beginning of this story. We don't know how it ends, we don't know how far it goes, but one thing is certain: the coming weeks and months will define the future of the global economy. And now we go deeper, because even after understanding all of this, there is still a deeper layer that most people completely ignore, and that is the hidden structure of how global financial systems actually operate. Because what we see on the surface, stock prices going up and down, oil prices rising or falling, inflation numbers changing, these are just symptoms. But the real story lies underneath, in the structure of how money flows, how liquidity moves, and how power is distributed across the system. And right now that structure is under stress. To understand this, think about how modern economies are built. They are built on credit, on borrowing, on the assumption that growth will continue and that future income will justify present spending. And for years this system has worked because interest rates were low, liquidity was abundant, and central banks were ready to support markets whenever needed. But now that environment has changed. Interest rates are higher, liquidity is tighter, and central banks are more cautious. And this changes everything, because when liquidity tightens, the entire system starts to feel pressure. Assets become harder to sustain, valuations come under scrutiny, and risk becomes more expensive. Now combine this with a sudden external shock like rising oil prices and geopolitical tension, and what you get is a system that is already stretched being pushed even further. And this is where fragility becomes visible, because systems that look stable during good times often reveal their weaknesses during stress. Now consider how global capital flows work. Money does not stay in one place, it moves across markets, across countries, across asset classes, searching for returns and stability. And when uncertainty increases, that flow changes direction. Capital starts leaving riskier assets and moves towards safety, and this shift can amplify market movements, because when large amounts of capital move simultaneously, prices adjust rapidly, sometimes more rapidly than fundamentals would justify, and this creates volatility, not just because of the underlying events, but because of how participants react to those events. Now let's talk about leverage, because leverage is one of the most powerful forces in financial markets. It allows investors to amplify returns by using borrowed money, but it also amplifies losses, and when markets move against leveraged positions, it forces liquidations, which means assets have to be sold to cover losses, and this selling can trigger more selling, creating a cascade effect. And this is one of the mechanisms through which small shocks can turn into large market movements. Now imagine a situation where rising oil prices increase inflation expectations, which keeps interest rates high, which puts pressure on leveraged positions in equities and other assets, and that leads to forced selling, which pushes markets lower. And as markets fall, furthermore positions get liquidated and the cycle continues, and this is how volatility can escalate quickly. Now, let's connect this to the broader economic environment, because markets and economies are deeply linked. When financial conditions tighten, it affects real economic activity. Companies face higher borrowing costs, consumers face higher loan rates, investment slows down, and this impacts growth. And when growth slows, earnings expectations decline, and that feeds back into markets, creating a loop between financial and real economic systems. And this loop is what makes downturns more complex, because it is not just one direction, it is feedback in both directions. Now consider the role of policy responses, because governments and central banks are not passive observers. They respond to changing conditions, but their tools have limitations, especially in situations where multiple objectives conflict with each other. For example, controlling inflation while supporting growth becomes difficult when the drivers of inflation are external, such as energy prices and geopolitical disruptions, and this limits the effectiveness of traditional policy measures. And when policy effectiveness is uncertain, markets become more sensitive to data and events, reacting quickly to any new information because participants are trying to anticipate what policymakers might do next. Now let's talk about global coordination, because in previous crises, coordinated actions by central banks and governments helped stabilize markets. But in the current environment, geopolitical tensions make coordination more challenging because countries may have different priorities, different constraints, and different strategies, and this lack of coordination can increase uncertainty and prolong volatility. Now here's another dimension: the role of technology and information flow, because today information spreads instantly. News travels across the world in seconds. Social media amplifies reactions, and market participants respond faster than ever before, and this speed can intensify market movements because decisions are made quickly, sometimes without full analysis, and this can lead to overreactions in both directions. Now think about behavioral dynamics, because markets are ultimately driven by human decisions, and humans are influenced by emotions, cognitive biases, and social factors. Fear, greed, herd behavior, all of these play a role, and during periods of uncertainty, these factors become more pronounced. People tend to follow the crowd, they react to headlines, they focus on short-term movements, and this can create patterns that are not always aligned with long-term fundamentals, and understanding these patterns is crucial because they can create both risks and opportunities depending on how they are navigated. Now let's shift to structural changes, because beyond the immediate situation there are long-term trends shaping the global economy: energy transition, technological innovation, demographic shifts, changing trade patterns. All of these factors are influencing how economies evolve, and the current situation interacts with these trends, sometimes accelerating them, sometimes disrupting them, and this adds another layer of complexity, because the future is not just a continuation of the past, it is a transformation. Now consider the energy transition, for example. While the world is gradually moving towards renewable, now let's talk about risk management, because in environments like this, managing risk becomes more important than seeking maximum returns. Investors focus on diversification, on liquidity, on resilience rather than aggressive growth, and this shift in strategy can influence market dynamics, because when a large number of participants adopt a defensive posture, it can limit upside momentum and increase downside sensitivity. Now bring all of this together, and what you see is a highly interconnected system where financial markets, economic activity, policy decisions, geopolitical events, and human behavior all interact in complex ways, and when stress is introduced into this system, the interactions can produce outcomes that are difficult to predict, because small changes in one area can have large effects in another, and this is why the current situation deserves attention, because it is not just about what is happening, it is about how different components of the system are responding and adapting. Now, let's return to the question of what happens next, because while uncertainty remains, there are scenarios that can be considered. If tensions stabilize and supply chains remain intact, oil prices could moderate, inflation pressures could ease, and markets could find support. But if disruptions continue and uncertainty persists, the adjustment process could be longer and more challenging, involving periods of volatility and slower growth, and during such periods patience and discipline become important, because reacting impulsively to short-term movements can lead to suboptimal decisions, while maintaining a structured approach based on analysis and risk assessment can help navigate the environment more effectively. Now consider the broader implications, because events like this often lead to changes in policy frameworks, in investment strategies, and in economic structures. Lessons are learned, systems are adjusted, and new approaches are developed, and while the transition may be difficult, it also creates the foundation for future stability and growth. And this brings us to an important perspective, because while crises are often viewed negatively, they also play a role in evolution. They expose weaknesses, they drive innovation, they force adaptation, and over time, they contribute to the development of more resilient systems. Now, as we move forward, the key will be to monitor how different variables evolve, how oil prices behave, how central banks respond, how geopolitical dynamics unfold, and how markets adjust to new information, because these factors will shape the trajectory of the global economy in the coming period. And while uncertainty cannot be eliminated, it can be managed through awareness, preparation, and adaptability. And ultimately, this is what defines outcomes, not the absence of challenges, but the ability to respond to them effectively. And as this story continues to unfold, it will provide insights not only into current conditions, but also into the underlying mechanisms that drive economic systems, and understanding those mechanisms is essential for navigating both risks and opportunities, because in the end, the global economy is a dynamic system constantly evolving, influenced by countless variables and shaped by human decisions. And in such a system, change is inevitable, but with change comes the possibility of growth, of improvement, and of new opportunities. And recognizing this balance between risk and opportunity is what allows individuals and institutions to move forward with clarity, even in uncertain times. And so, as we observe the developments ahead, it is important to remain informed, to think critically, and to approach decisions with both caution and perspective, because while the environment may be challenging, it is also a moment of learning and adaptation. And in that sense, what we are witnessing is not just a disruption, but a process through which the global system adjusts, recalibrates, and prepares for the next phase of its evolution. And that phase, while uncertain, holds the potential for both challenges and opportunities, depending on how it is navigated. And now we reach the final thought, because at the end of the day, the global economy is not just numbers, it is people, decisions, behavior, and reactions. And those reactions shape outcomes. So the only question that truly matters is, are we paying attention, or are we waiting until it is too late?